This program provides education, not advice. Sponsors pay a fee for endorsements and interviews. See the truthayf.com disclosure page for details.
This is where technology, innovation, and personal finance come together.
This is the truth about your future with Rick Edelman.
Support for the truth about your future with Rick Edelman comes from Invesco QQQ. 25 years ago, Invesco QQQ rethought the investing landscape by providing access to the Nasdaq's 100 most innovative companies, all in one ETF. What's ahead for the next 25 years? Could it be flying cars, neural implants, electric planes? Nobody knows for sure. But one thing's for certain. You can gain access to that progress with Invesco QQQ ETF. Let's rethink possibility. There are risks when investing in ETFs, including possible loss of money. ETF risks are similar to those of stocks. Investments in the tech sector are subject to greater risk and more volatility than more diversified investments. The Nasdaq 100 Index comprises the 100 largest non-financial companies on the Nasdaq. You can't invest directly into an index. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Visit Invesco.com for prospectus containing this information. Read it carefully before investing. Invesco Distributors, Inc.
It's Thursday, August 29th. I got an email from Sam in Rhode Island, and here's what he said.
I own 4 mutual funds along with a few stocks. When I started buying the funds about 40 years ago, I was told that funds don't have to report their price until 6:30 p.m. With today's computers, shouldn't they be able to compile my list a lot earlier?
Sam, you're asking the wrong question. Instead of complaining that mutual funds are operating in an antiquated, obsolete, out-of-date methodology, the question you should be asking as you look in the mirror is, why do I still own these things? That's really what it comes down to. You're right to be frustrated. It's silly. It's dumb. It doesn't make any sense. Mutual funds were a wonderful innovation when they were introduced here in the United States in the 1920s. And they became a great way for the masses to engage in the financial markets in a manner they couldn't otherwise afford to do in the 1950s and 60s and 70s and 80s. But that was then. This is now the 2020s. There's no reason for you to be dealing with these because we have the next iteration in investment management. We've gone from individual securities to mutual funds, and now we've gone from mutual funds to exchange-traded funds. These things are far more technologically advanced than mutual funds. There's $20 trillion in mutual funds, only $8 trillion in ETFs. So mutual funds remain dominant. People like you, out of habit, owning them. You began investing 40 years ago in these things, you said, and just out of habit, you're persisting in doing that. But what you're not doing is recognizing the opportunity to keep up with the times. Other people are doing this, and Citibank just released a report saying that over the next 10 years, half the money in mutual funds are going to leave and go to ETFs, to exchange-traded funds. In other words, the 20-8 score right now, 20 trillion in mutual funds to 8 trillion in ETFs, over the next 10 years, it's going to go from 20-8 to 18 to 10. In other words, the 20 trillion in mutual funds is going to get cut to 10, and the 8 in ETFs is going to rise to 18. I've been telling you this for years, that investors are going to be shifting out of mutual funds. Mutual funds aren't even going to exist in the future because of the benefits of ETFs. ETFs are cheaper. Typically, mutual funds charge 1.5%. They routinely charge more than half a point, 3/4 of a point, a full point per year. ETFs are as cheap as 5 basis points. It's routine to find them charging 15, 20, 25 basis points. That's 1/4%, 25 basis points. They're dramatically cheaper than mutual funds, and they are far more tax efficient. In other words, you have to pay taxes every year on the capital gains produced by your mutual fund. Even if you don't do any buying or selling yourself, you're going to pay capital gains because of the trading done by the fund company manager. But ETFs, that's not true. You're only going to pay taxes if you, in fact, sell the fund, regardless of the trading done by the manager itself. So they're far more tax efficient, and that makes them cheaper to own on top of the cheaper fees. And they are also, to your point, Sam, far more liquid. In other words, mutual funds only trade once a day, at the end of the day when the market closes at 4 o'clock. This is why mutual funds don't report the price until 6:30, because they don't know what the price is. They got to do the calculation based on the days buying and selling that they tally up at 4 p.m. Takes them a while to do it. But ETFs, they're liquid. They trade throughout the trading day. You always know in real time exactly what your ETFs are worth. So instead of complaining that mutual funds don't tell you the value of your account until 6:30 p.m. nightly, why not just put your money into ETFs where you'll know every moment throughout the trading day exactly what your value is? Sam, you own mutual funds. You've been doing this for 40 years. You're complaining that they aren't operating as efficiently and as effectively as you would like. And oh, by the way, you're paying more to own them. And oh, by the way, you're paying more in taxes to own them. Sam, it's time to get rid of your mutual funds and shift over to ETFs. What are you waiting for? Coming up next, I received another interesting question from Lou in New Jersey. I'll tell you what she asked in 60 seconds.
Electricity, a big idea that's inspired countless new ones. From powering the light bulb to virtually powering our entire lives. 30 years ago, State Street launched the Spider S&P 500 ETF, SPY. A big idea that inspired the world to invest differently, and still does. What can you do with SPY?
Before investing, consider the fund's investment objectives, risks, charges, and expenses. Visit ssga.com for a prospectus containing this and other information. Read it carefully before investing. SPY is subject to risks similar to those of stocks. All ETFs are subject to risk, including possible loss of principal. Alps Distributors, Inc. Distributor.
Welcome back. The Truth About Your Future continues. And here's another question that I got from Lou. She lives in New Jersey.
I'm 69 years old, female, married, and I want to retire in 2 years. I want to add more to my investments, but I was told I should not be in the market at my age. I say never be out of the market. What do you think?
Lou, I think that you should never again talk to the person about money who has said you're too old to be in the market. That's crazy. You're only 69 years old. Now, if you've got a health issue I'm not aware of, if you have a short life expectancy that, God forbid, I'm not familiar with, then maybe I could see that. And if you don't have any money at all, if you don't have any cash savings, if you don't have any savings in the bank, no cash reserves, well then, okay, maybe. But for most folks who have plenty of assets, hundreds of thousands of dollars or more, most folks like that who are merely 69 years old, the old traditional attitude that someone in their 60s or 70s shouldn't have much money in the market, that's antiquated. That's out of date. That's no longer relevant. Today, a lot of folks in their 60s and 70s are going to be living into their 90s and hundreds. You've got 20, 30 years or more of life to live. Would that individual who told you to not be in the market at your age, would they make the same comment to someone in their 30s or 40s or 50s? I don't think so. And that's because they would say, oh, this person has many years to go. But so do you at age 69. So I agree with you to never be out of the market. I think you should continue an exposure in the stock market for decades to come. The real question is how much of your money, what percentage of your portfolio should be invested in the market, and what exactly should you be buying out of the multitude of opportunities in stocks? What is it you should be investing in? Those are questions for you to tackle with your financial advisor. But above all else, since you're 69, female, married, and not yet retired, I think whoever told you not to be in the market at your age is someone you should no longer discuss finances with. You can send me your question as well. Just send it to askrick@thetruthayf.com. The link is in the show notes. You get a lot more benefit by getting your education, your information from talented, qualified people. And I've got one coming up for you, Jerome Snyder from PIMCO. This is the world's largest bond manager, and we're doing a webinar together on Wednesday, September 11th at 1 p.m. Eastern. Interest rates are going to be coming down for the first time in years. PIMCO's all over this, and that's why I've asked them to come and do an event with us, and we're going to talk with you about how you ought to handle your bond portfolio in your assets as a result of declining interest rates. Huge new different opportunity from just a couple of years ago. Let's make sure you're managing your assets correctly. I encourage you to come to this event. It's free. The link is in the show notes. You can register for it right now. If you're a financial advisor, you get 1 CE credit, and you'll learn the new fixed income opportunities as a result of a declining interest rate environment. Sign up today. I'm glad you're with me here on The Truth About Your Future. If you like what you're hearing, be sure to follow and subscribe to the show wherever you get your podcasts, Apple, Spotify, YouTube. And remember, leave a review on Apple Podcasts. I read them all. Never miss an episode of The Truth About Your Future. Follow and subscribe on your favorite podcast app. And we're giving our staff tomorrow off and Monday off so they can enjoy the holiday weekend. See you on Tuesday. Have a great Labor Day weekend.
Increased awareness and actionable intelligence about the forces that are shaping our world.
This is The Truth About Your Future with Rick Edelman.